Hey there, and welcome to What If from Koala. Today we're diving into a really fascinating, high-stakes hypothetical scenario. Just imagine this. It's mid-2025. The U.S. economy is, well, teetering, caught between rising inflation on one side and suddenly a weakening job market on the other. And then the Federal Reserve makes a truly defiant move. Almost unthinkable, really.
Yeah, what we're exploring here is a situation where the Fed, maybe in a bold, or you could even say desperate attempt to protect its mission, its independence, it decides to deliberately trigger a recession.
Wow.
And this isn't just, dry economic policy. It's about institutional integrity. It's a direct challenge, really, to the White House itself.
Exactly. It's a what if that could fundamentally reshape, maybe for decades, the whole relationship between the government and the central bank. So our mission today is to unpack the economic dynamics behind such a decision, the inevitable political fallout, and of course, the global ripples.
Yeah.
Okay, let's get into it. So to really grasp the gravity of the Fed's potential gamble here, we first need to set the scene. Mid-2025. Your sources paint this picture of an economy caught in a really treacherous cross-current, battling rising costs and a rapidly cooling job market. It's like a dual shock, isn't it? Leaving it incredibly vulnerable.
It really is. And what's particularly fascinating, I think, is how these two forces, these negative forces, are interacting. On one side, you've got significant inflationary pressure. And the sources suggest this is largely driven by the administration's, aggressive trade policies.
Aggressive is putting it mildly based on the source material.
Yeah.
It mentions an all-out assault.
That's the term used, yeah. An all-out assault using tariffs. And importantly, these aren't just aimed at, say, traditional rivals. They're also hitting long-standing allies. I mean, the numbers are quite something. 35% on Canada.
35%.
Yeah. 50% on Brazil, 39% on Switzerland, 20% on Taiwan, 15% on the EU. It's broad.
Those are huge percentages.
Yeah.
So what does that actually mean for, the average person? What's the impact on their wallet?
Well, the cumulative effect is pretty dramatic. The average U.S. tariff, according to the sources, skyrocketed from around 2.5% in early 2025 to a staggering 18.3%.
18.3.
18.3, which, to give some context, is apparently the highest average tariff rate the U.S. has seen since 1934.
Wow. Since the Great Depression era.
Exactly. And for you, the consumer, this translates directly into higher prices. It acts essentially like a consumption tax. The estimate from the material is this costs the average U.S. household an extra $2,400 a year.
$2,400. That's significant. And are we seeing this in the inflation data itself?
Oh, absolutely. It's clear in the data. The Fed's preferred measure, the PCE price index, it rose from 2.4% annually in May to 2.6% in June, and overall inflation hit 2.7% in June. So definitely heating up.
And how did the rest of the world take these tariffs? I can't imagine they were pleased.
No, not at all. The reaction was stark, deeply negative. Canada, for instance, publicly called it factless tariff chaos.
Factless tariff chaos.
Okay. Switzerland, another partner, expressed deep regret. So this creates an already tense, sort of fragile global economic environment, which, as we'll see, really amplifies the negative impacts if the U.S. were to, deliberately induce a recession.
Okay, so one side of the vice is inflation, heating up because of trade policy.
Right.
But the other side, simultaneously, the job market is weakening. And not just a little bit, right? This is where it gets really interesting.
Indeed, that July 2025 jobs report, it wasn't just soft. It signaled a really alarming underlying weakness. It suggested the economy was on much shakier ground than maybe policymakers realized at first.
What were the headline numbers?
Well, the headline numbers were worrying enough. Only 73,000 jobs added in July, way below what people expected. And unemployment ticked up to 4.2% from 4.0%.
Okay, bad, but maybe not catastrophic on the surface. But the real story, as you often find with this data, is in the revisions, isn't it?
Absolutely. That's where the bombshell was. A colossal 258,000 jobs were revised downward for the 2 months before that, May and June.
250,000 jobs just vanished from the previous reports.
Vanished. May's growth was slashed from an initial 144,000 all the way down to just 19,000.
Wow.
And June saw a similar huge cut from 147,000 down to only 14,000 jobs added.
14,000, that's basically zero net growth.
Pretty much stagnant. It brings the 3-month average job growth down to just 35,000, which is dramatically lower than the 121,000 average initially reported for that period. So this huge revision means the labor market was losing steam way before anyone fully got it, making the whole economy much more fragile.
So the ground was already crumbling beneath the surface, essentially. Were there specific sectors showing this weakness?
Yes, and that's telling too. Even manufacturing, which you might think would benefit from tariffs, right? More domestic production.
Right, that's the theory.
Well, it lost 11,000 jobs in July. That was its third straight monthly decline. And even the federal government cut 12,000 jobs. So it's widespread weakness. This means any big policy shift, like a rate hike, could easily push this teetering economy over the edge.
Okay, so we've got this really precarious situation. Inflation rising sharply from trade policy, and the job market, we now know, was much weaker than thought, showing these deep underlying problems. This is the pincer movement you mentioned earlier, a really tight spot.
Yeah.
And it's in this incredibly fragile, politically charged environment that our what-if scenario has the Federal Reserve making a deliberate, really challenging decision: raise rates sharply.
Exactly. And it's crucial to understand this isn't just an economic calculation in this scenario. It's a profound political statement. The Fed, in this hypothetical, is acting not just to control inflation, but also, maybe primarily, to safeguard its long-term independence, its credibility.
Like drawing a line in the sand.
Precisely. The sources frame it as a potential modern-day Volcker shock, referencing Paul Volcker back in the 80s.
Right, when he famously induced a recession to kill inflation.
Exactly. A very controversial move, but ultimately seen as establishing the Fed's anti-inflation credibility for, well, generations. The Fed here would feel trapped in a kind of credibility trap, you could call it.
A credibility trap? How so?
Well, if it doesn't act forcefully against inflation that it sees as politically driven, coming from these tariffs, not the normal business cycle, it risks looking like it's just caving to the White House.
Losing its independence in the eyes of the market and the public.
Exactly. And that could unanchor inflation expectations, which is a central banker's nightmare.
Right. Once people expect prices to keep rising, it becomes a self-fulfilling prophecy.
Precisely. So the choice becomes, in this scenario, a painful but maybe shorter recession now versus a potentially longer period of stagflation, stagnant growth, high inflation, and completely eroded credibility later.
And how would they justify causing a recession, politically and publicly?
They'd root it in their dual mandate: price stability and maximum employment. The argument would be that price stability is the essential precondition for achieving maximum employment in the long run. You can't have one without the other, eventually.
Okay, but this isn't happening in some theoretical vacuum. The administration's reaction.
Yeah.
It's not a risk. It's basically a certainty, given past behavior described in the sources.
Absolutely a certainty. The administration has a very clear, established pattern for dealing with inconvenient facts or institutions. Look at the precedent. The immediate firing of the BLS commissioner, Erica McIntarfer, right after that weak July jobs report we discussed.
Yeah, you mentioned that. What was the accusation?
The claim was the BLS was run by a Biden appointee, technically true but irrelevant to the data integrity, and that the numbers were rigged and manipulated for political purposes. Despite, zero actual evidence, that exact playbook would be turned on the Fed, no question.
And it goes beyond just attacking the institution, right? There have been personal attacks, too.
Oh, yes. Direct attacks on Fed Chair Jerome Powell already happened, according to the sources. The president accusing him of playing games with rates to influence elections, saying he should be put out to pasture. This isn't hypothetical stuff, it's documented.
Put out to pasture. Wow.
Beyond rhetoric, there's a willingness to use official channels. Look at the Office of Special Counsel investigating former prosecutor Jack Smith, requested by a political ally. You could absolutely see Fed governors facing similar politically motivated investigations into their finances, their conduct, anything to intimidate.
So the Fed, in making this decision to hike rates, would absolutely know it's kicking off an unprecedented political war with the White House.
Yes, it's a strategic gamble. A gamble for the independence, maybe even the soul of the institution itself.
They'd be going in eyes wide open,
Yeah.
fully aware of the political firestorm.
Believing, perhaps, it's the only way to preserve that independence long-term, even if the short-term cost is immense.
Okay, so the Fed pulls the trigger, hikes rates sharply, going completely against market expectations, which were for a cut,
Yeah.
and obviously against the explicit wishes of the White House. What happens next? To the economy,
Agnostically.
globally.
Well, the impact, the transmission mechanism, would be swift and, frankly, brutal, especially for an economy already so fragile. First, just sheer market shock. Financial markets were pricing in a cut in September.
Right.
So a surprise hike, you'd see a violent repricing. Remember, the weak jobs report alone caused a 1.5% stock market drop. A surprise hike like this would trigger a much, much larger sell-off in stocks, panic on Wall Street, and bond yields would spike sharply. Borrowing costs would jump for everyone instantly.
Which leads straight to a credit crunch, I imagine.
Exactly. Higher borrowing costs immediately choke off business investment. Consumer credit for homes, cars, everything dries up or gets way more expensive. Companies, many already struggling with those tariffs we talked about, suddenly face a severe credit crisis.
Leading to bankruptcies, layoffs.
A wave of them, yes. Bankruptcies, widespread layoffs. Unemployment, already at 4.2% in July, would surge. Well beyond that. Maybe 6%, 7%, or even higher. Quite quickly.
And consumer spending, the engine of the U.S. economy.
It would collapse. People facing job losses, higher mortgage payments, higher credit card debt, they just stop spending. And that creates a vicious cycle, right? Reduced demand leads to more layoffs, which further reduces demand, pushing the economy into a deep, painful recession. No soft landing here.
And this chaos wouldn't just stay within U.S. borders, would it? The global economy is so linked.
No, absolutely not. The international repercussions would be severe and immediate. A big Fed rate hike leads to a rapid, massive appreciation of the U.S. dollar.
Ah, the dollar wrecking ball idea.
That's exactly it. The dollar wrecking ball scenario. It destabilizes the whole global financial system. Why? Because countries, corporations around the world, they often borrow in U.S. dollars.
Right.
So if the dollar suddenly gets much stronger against their local currency, their debt burden just skyrockets. It becomes much harder, maybe impossible, to pay back those dollar loans.
So existing debts suddenly become crushing, potentially triggering defaults overseas.
Potentially, yes. A wave of defaults, especially in emerging markets. And this dynamic, plus higher U.S. interest rates, triggers a massive flight to safety. Capital flees emerging markets and floods into the U.S., which forces other central banks into an impossible choice.
What's the choice?
Either they raise their own interest rates sharply to defend their currency and stop the capital flight, but that deepens their own domestic recession, or they let their currency collapse, which leads to soaring inflation and economic chaos at home. A terrible choice either way. Emerging markets, maybe just starting to recover, would see that progress violently reversed.
And what about trade, beyond the currency effects?
Well, a U.S. recession means drastically reduced demand for imports. So major trading partners, Canada, Brazil, the EU, Taiwan, places already reeling from those tariffs.
Yeah, Canada at 35%, Brazil 50%, Switzerland 39%.
Exactly. They'd see demand for their exports just plummet. Remember, Canada called the tariffs feckless tariff chaos. Switzerland expressed deep regret. This turns those existing trade disputes into a full-blown, synchronized global recession.
Wow. So it cascades. It could lead to retaliation, too. A breakdown of trade?
Very possibly. Retaliatory tariffs, breakdown of the international trade order, severe supply chain disruptions, a truly global mess kicked off by this Fed action.
Okay, so the economic fallout is, well, catastrophic, both at home and abroad. But let's get back to the Fed itself. They might achieve their narrow economic goal, quelling inflation, albeit brutally. But what's the political fallout for the Fed? What specific pushback would they face from an enraged White House, based on the patterns described?
Well, based on those patterns, we can anticipate a pretty specific, multi-pronged counterattack designed to undermine the Fed's authority and legitimacy. First, a sustained public campaign. Relentless media assault via social media, allied news outlets, accusing the Fed of deliberately sabotaging the economy for political reasons. Echoing that rigged rhetoric used against the BLS, the narrative would be, this unelected elite is hurting you, the American people, on purpose.
So attacking the messenger, delegitimizing the institution itself in the public eye. A familiar tactic.
Very familiar. Then you'd get open threats to personnel. Even if firing the Fed chair is legally tricky, the administration would absolutely make public threats to fire the chair, the governors. The goal isn't necessarily immediate removal, but to create that climate of intimidation, sow public doubt about their right to hold office.
And threats against the institution's structure itself.
Yes, legislative threats. The administration would encourage allies in Congress to introduce bills aimed at curtailing Fed independence. Things like maybe requiring congressional audits of monetary policy decisions, which are currently shielded from direct political review, or even trying to alter the Fed's dual mandate itself, maybe strip away the employment part, make it solely about inflation, but under tighter political control.
And finally, weaponizing other parts of the government.
That seems likely too, based on precedent. Launching investigations, maybe through the DOJ or other agencies, into the personal finances or conduct of Fed governors, mirroring that strategy used against Jack Smith: harass, intimidate, distract.
This sounds, well, it sounds like a Pyrrhic victory for the Fed, doesn't it? They might win the economic battle against inflation technically, but at what cost to their actual independence?
That is the absolute core paradox here, the central irony of this whole what if. On one hand, yes, maybe in the eyes of global markets, other central banks, the Fed does restore its reputation. It looks independent, tough on inflation, committed to price stability above politics. That could anchor future inflation expectations, which has long-term benefits. International trust in the dollar might even solidify.
Okay, so some potential upside on the credibility front, globally at least. But the downside seems enormous.
Immense. Because that fierce public battle with the White House could permanently shatter the political consensus, the kind of unwritten agreement that has protected the Fed's independence for decades in the U.S. The Fed might emerge credible on the world stage, but its legal and political autonomy at home could be severely weakened, making it much more vulnerable to political pressure next time in the next crisis.
And the public reaction to an intentionally caused recession.
That's crucial. By intentionally causing a deep recession with widespread job losses, the Fed faces immense public outrage. Understandably so. It's no longer seen as this technocratic manager, tweaking dials behind the scenes. It becomes seen as this unelected body causing widespread suffering. That erodes public legitimacy, which is ultimately the bedrock of its power.
So the very act they take to prove their independence, their de facto independence, their ability to act, might actually lead to losing their formal or de jure independence through political backlash. That's the tragic paradox you mentioned.
That's exactly it. The Fed tries to prove it's independent by inflicting economic pain, believing it's necessary. But that very act of causing pain inevitably triggers a massive political and public backlash led by a hostile White House. And that backlash, fueled by genuine public anger, could easily lead Congress to pass laws that formally reduce the Fed's independence, making it more subject to political whims in the future. So the act of demonstrating independence paradoxically leads to losing it.
Wow. So what does this all mean for you, listening right now? This hypothetical scenario, the Fed intentionally challenging the White House, triggering a recession. It's not just some academic policy debate. It's an institutional gamble of truly epic proportions. A real what if that pushes us to think about extreme risks in the system.
Yeah, our analysis suggests this represents what we call a tail risk. A low probability, perhaps, but incredibly high impact event. It could trigger that synchronized global recession we talked about and fundamentally reshape the relationship between the U.S. government and its central bank for decades. The forces described in the sources, the tariff-driven inflation, the rapidly weakening labor market revealed by revisions, the highly politicized environment, they create a landscape of deep instability, maybe deeper than many realize.
So for you, whether you're an investor trying to navigate what could be incredibly volatile markets, or a policymaker thinking about institutional limits, or maybe just someone curious about the powerful forces shaping our world, this scenario serves as a stark warning. The possibility of an open, hostile conflict between the monetary authority and the executive branch of the world's largest economy. It's apparently no longer unthinkable.
And the consequences would be widespread, they'd be profound, and ultimately deeply unpredictable. It demands extreme caution and, strategic resilience from everyone involved.
It certainly leaves us with a lot to think about. What really stands out to you from exploring this specific what if, and maybe for you listening? How should an institution like the Fed navigate such incredible pressures, trying to balance its mandates with these intense political realities? Something to ponder.
Until next time, keep thinking critically.